Ever wished your investments could just hand you, like, a steady income?
Yeah.
Today, we're diving into QYLD.
Okay.
It's this Nasdaq-focused ETF,
Okay.
and it claims to do just that,
Uh-huh.
with these, like, unusually high dividends. But, as we all know, sometimes flashy promises come with hidden costs, right?
Absolutely.
So you sent us some interesting research on this.
Okay.
A comparison chart, a history of QYLD's payouts, and a detailed analysis in Chinese.
Wow. Okay.
So let's unpack whether QYLD is like a golden goose or a wolf in sheep's clothing.
I like that. Let's see what we have here.
And don't worry, we've got our expert here to decipher all the technical bits.
Sounds like a fascinating case.
Well, this chart from January 9th, 2025 definitely caught my eye. It compares QYLD to QQQ, which tracks the Nasdaq 100. With dividends reinvested, QYLD turned $10,000 into over $66,000 in just 11 years. QQQ. A respectable $22,940.
That's more than triple the return.
Yeah.
Color me intrigued.
Right.
But also a little skeptical. The Chinese analysis, it mentions that QYLD has consistently paid out around 12% in dividends annually for the past decade.
Yeah.
That's way above average, so there's got to be something else going on under the hood.
Right. And I noticed in this payout history that QYLD even gave investors a surprise stocking stuffer dividend of almost 50 cents a share back in December 2021.
Special dividends are always nice.
Yeah.
But they often hint at, like, a specific play within the fund's strategy.
Okay, so these returns are impressive, but almost too good to be true. What's the catch? How is QYLD actually generating these dividends?
The answer lies in a strategy called covered calls,
Okay.
which involves options trading.
Yeah.
Essentially, QYLD doesn't just buy Nasdaq 100 stocks. It also sells options contracts. These contracts give someone else the right to buy those stocks from QYLD at a set price.
So it's like QYLD is giving up some potential profits in exchange for upfront cash from selling those options. And that cash is what funds the dividends.
You got it. Now, it's important to understand that QYLD focuses on selling at the money calls. This means the strike price, the price at which the buyer can exercise their option, is very close to the current market price of the stock.
Interesting. So how does this, like, at-the-money choice affect the risk and reward for QYLD investors?
It creates a sort of ceiling on potential gains. If the Nasdaq 100 suddenly takes off, QYLD won't fully participate in that growth because they've already committed to selling those stocks at the predetermined price. Think of it like this. Imagine you own a bakery and sell someone the right to buy 100 loaves of bread for $2 each tomorrow. You get that $200 today, but if the price of bread skyrockets to $5 tomorrow because of, like, a flour shortage, you're still obligated to sell those loaves for $2.
Okay.
You miss out on the extra profit, but you had the security of that initial $200.
Okay, I see the trade-off. You get consistent income, but you might miss out on some big wins. So tell me, are there other types of covered calls, and how does QYLD's at-the-money approach compare?
There are indeed. You could sell out of the money calls where the strike price is higher than the current stock price.
Okay.
This gives you more potential upside, but you get less premium income up front. QYLD chooses at the money to maximize that income stream for dividends. It all comes down to, risk appetite and investment goals.
So we've seen how QYLD generates those enticing dividends, but like any investment strategy, this comes with some caveats, right?
Exactly. The Chinese analysis highlights some key risks. First, even with the buffer from options premiums, QYLD isn't immune to market drops.
Right.
It still holds those Nasdaq 100 stocks, so if the market takes a hit, QYLD's value will decline as well.
Meaning this isn't a risk-free way to get income.
Definitely not. The analysis points out that QYLD actually took longer to recover from the 2020 crash than growth ETFs like SPY and QQQ.
That's interesting. Why would QYLD lag behind in a recovery? I thought the covered call strategy provided some downside protection.
It does, but remember, those covered calls also limit the upside potential. When the market starts to rebound, QYLD can't fully capitalize on those gains because they're still obligated to sell those stocks at the lower strike prices they set when selling the call options.
Okay.
SPY and QQQ, on the other hand, don't have that constraint and can ride the recovery wave more freely.
No, that makes sense. So even with those options premiums, QYLD has a unique vulnerability during market swings. What else should investors be aware of?
Well, another factor to consider is the fees. QYLD has a management fee of 0.6%, which is higher than SPY or QQQ.
Right.
This eats into your returns over time.
Yeah.
For long-term investors, that difference can add up. You mentioned that QYLD was a listener request. Perhaps they had some concerns about these fees.
That's a great point. I'm starting to see how covered calls work, but I'm still a bit wary of options. What would you say to someone hesitant about this strategy?
It's understandable to be cautious with options.
Uh.
They can seem complex, but at their core, they're just contracts that give you the right to buy or sell an asset at a specific price. With covered calls, you're leveraging those contracts to generate income. It's not for everyone. And it's definitely crucial to do your research and understand the mechanics before diving in.
Well said. So with all this in mind, who is QYLD actually a good fit for?
That's the key question, isn't it? The Chinese analysis emphasizes that QYLD is not about, rapid growth.
Right.
It's about generating that consistent income stream, almost like a bond, but with the potential for some growth tied to the Nasdaq 100.
So it could be a good fit for income-focused investors like retirees.
Right.
Or someone looking to supplement their income.
Exactly.
The Chinese analysis also mentioned dollar cost averaging.
Yeah.
Is that something investors should consider with QYLD?
It certainly could be. Dollar cost averaging is simply investing a set amount at regular intervals regardless of the price. This helps to mitigate the risk of buying at a market peak. The analysis also suggests buying QYLD during market dips, as this can enhance the yield on your investment.
Now, you mentioned that the Chinese analysis highlights other income-generating ETFs. That piqued my curiosity.
Okay.
What can you tell us about them?
It seems there's a whole ecosystem of ETFs designed for income generation, each with its own approach and risk profile. Some use covered calls, but with adjustments to potentially limit downside risk, while others focus on high dividend stocks in specific sectors.
So there are options beyond just QYLD.
Many options.
You give us a few examples.
Absolutely. One example is the JPI ETF. Like QYLD, it uses a covered call strategy, but it focuses on the S&P 500 instead of the Nasdaq 100.
Right.
This could provide broader market exposure
Yeah,
and potentially less volatility.
that makes sense. What about an ETF that focuses on downside protection?
Well, there's new SI. It utilizes a strategy called protective put options,
Okay.
which act like insurance against market drops.
Hmm.
Think of it like buying a warranty on your investments. It costs a bit in fees, but it can help cushion your portfolio during, turbulent times.
Okay, so JPI for a broader approach.
Right.
And NUSI for those who prioritize protection.
Exactly.
What about investors seeking higher growth potential alongside income?
For that, the analysis mentions SCHD.
Okay.
This ETF focuses on high-quality dividend-paying companies with a history of increasing those dividends over time. It doesn't use options, but relies on solid fundamentals and dividend growth to generate income and potential capital appreciation.
Wow, this is really fascinating. It sounds like investors have a wide range of choices when it comes to income-generating ETFs. It's not just a one-size-fits-all world out there.
Exactly. And just like we did with QYLD, it's crucial to understand the mechanics, potential benefits, and risks of each ETF before making any decisions. Research is key.
Thinking about these different ETFs and realizing that investing really is like building a house. You need a solid foundation of core holdings, like the S&P 500.
Yeah.
But you can also add specialty rooms and features depending on your needs and preferences. QYLD and these other income-generating ETFs could be like adding a sunroom for extra income and enjoyment.
That's a great analogy.
Yeah.
And just like you wouldn't add a sunroom without careful planning and consideration, you shouldn't jump into any investment strategy without doing your due diligence.
Well said.
Yeah.
So we've explored the ins and outs of QYLD, delved into its potential downsides, and even uncovered a whole ecosystem of alternative income-generating ETFs. What are your final thoughts on QYLD, and what key takeaway should our listener keep in mind?
QYLD is a fascinating tool
Yeah.
for generating income.
Right.
But it's not a magic bullet. It's all about understanding the trade-offs,
Yeah.
those limitations on growth potential in exchange for those consistent dividends.
Right.
It definitely has a place in some portfolios,
Yeah.
but it's not right for everyone.
So what's your advice to our listener as they consider whether QYLD fits their investment strategy?
I'd say the most important thing is to be clear about your investment goals and risk tolerance.
Right.
Are you primarily seeking income, or are you focused on long-term growth? How comfortable are you with market fluctuations?
Yeah.
Once you have a good grasp on those factors,
Right.
you can start to evaluate whether QYLD or any of the other income-generating ETFs we discussed aligns with your objectives.
It sounds like self-awareness is key.
Absolutely.
Don't just chase those high dividend yields without understanding the bigger picture.
Exactly. And this actually brings up an important point that the Chinese analysis touched on. Tax implications.
Oh, right.
Dividends from QYLD are taxed differently than capital gains.
Yeah.
Which could be a significant factor depending on your individual tax situation.
Yeah, for sure.
It's always wise to consult with a tax professional to understand the full impact of any investment strategy.
Good point. Investing isn't just about returns.
Right.
It's about keeping more of what you earn.
Exactly.
So if our listeners are intrigued by QYLD or these other income-generating ETFs, where would you recommend they start their research?
There are a wealth of resources available online.
Yeah.
Reputable financial websites like Morningstar or Seeking Alpha provide in-depth analysis and comparisons of ETFs.
Okay.
You can also find helpful information on investor forums.
Right.
Though it's always important to take those opinions with a grain of salt and verify the information through reliable sources.
Yeah, definitely.
And of course, don't hesitate to reach out to a financial advisor.
Right.
They can help you assess your individual needs and develop a personalized plan that incorporates these income-generating strategies if they align with your goals.
I think we've given our listener a lot to chew on today.
They have.
We've uncovered the mechanics of QYLD, explored its risks and rewards, and even opened the door to a whole universe of income-generating ETFs.
It's a big world out there.
Any final words of wisdom before we wrap up?
I'd just encourage our listener to remain curious and never stop learning. The world of investing is constantly evolving, and new strategies and opportunities are always emerging. The more you understand, the more confident and successful you'll be as an investor.
Beautifully said.
Yeah.
So to our listener,
yes,
thanks for sending us down this fascinating rabbit hole.
I enjoyed it.
QYLD is just one piece of the income-generating puzzle. Keep exploring, keep asking questions, and who knows? Maybe you'll discover the perfect ETF to build that financial sunroom you've always dreamed of.
Until next time, happy investing.